My name is Michael Grandy. I'm a certified public accountant, and I'm a professor at Providence College. I'm teaching an MBA class, which is essentially the graduate version of managerial accounting, and we're focusing in on standard costs and variances. We've already talked about direct materials variances, direct labor variances, variable manufacturing overhead variances, but we're going to talk about fixed manufacturing overhead variances. And there's two of them. There is the budget variance, and there is the volume variance. And the second thing that's very important about this material is that the standard price equals the predetermined overhead rate. So we know what the standard price is with regard to direct materials and direct labor. It's the price they should pay per foot or per gallon. It's the rate they should pay per hour. But when it comes to variable overhead and fixed overhead, we're talking about the predetermined overhead rate as the standard price. And we've defined how to calculate that back in chapter 2 when we were talking about job order costing. Specifically, a formula for the predetermined overhead rate is total estimated manufacturing overhead dollars divided by total estimated activity base. More specifically, estimated equals budgeted. The budgeted dollars, the budgeted activity level. Even more specifically, the planning budget information. Remember, the planning budget is the budget that's prepared in advance based upon an estimated level of activity. So what I'd like to do during this session here is to take a look at problem 10A, that's the appendix in chapter 10, problem 10. So let's read it together. Let's look at the solution. So wonderful. It says, not only did our salespeople do a good job in meeting the sales budget this year, but our production people did a good job in controlling costs as well, said Kim Clark, president of Martel Company. Our $18,300 overall manufacturing cost variance is only 1.2% of the $1,536,000 standard cost of the products made during the year. That's well within the 3% parameter set by management for acceptable variances. It looks like every 1 billion line for a bonus this year. The company produces and sells a single product. The standard cost card for the product follows. So what's important, as I mentioned before, is you got to look at three things. Number one, you need to find three things. Number one, what's the budgeted information? Budgeted information is going to be used to calculate predetermined overhead rates. You need to look for the standard cost card. The standard cost card is a summary of quantity and price information, what it should take to get the job done. And then thirdly, you need to look for the actual information. More specifically, you need to find and start with the actual level of output and then what the actual numbers are. So you see the standard cost card in front of you. They also provide you with the standard price for variable overhead and fixed overhead. The following additional information is available for the year just completed. The company manufactured 30,000 units of product during the year. So that's the actual output, 30,000 units. B, a total of 64,000 feet of material was purchased during the year at a cost of $8.55 per foot. All the material was used to manufacture the 30,000 units. There was no beginning or ending inventories. So here's a good thing for you. The amount purchased was the amount used. So there's no separate calculations as we've talked about before. C, the company worked, again, this is all the actual information, 43,500 direct labor hours during the year at a direct labor cost of $15.80 per hour. And then D, overhead is applied to products on the basis of standard direct labor hours. Data relating to the manufacturing overhead as follows. The denominator activity level. That's the estimated activity base used in calculating the predetermined overhead rate. Budgeted fixed overhead costs, actual variable, actual fixed. So the first part, items 1 and 2, is asking you to calculate materials, price and quantity variance. Number two, calculate labor rate and efficiency variances. So let me run through those, and you should be good at them now. And let's remember, we're looking at actual, which is AQ times AP. We're going to look at AQ times SP, and we're looking at SQ times SP. And let's remember, SQ is the most difficult number because we've got to start with the actual output, 30,000 units. And this is my direct materials I'm going to start with, right? The standard cost card says it should take 2 feet for each times 2 feet. They should have used 60,000 feet at a standard price of $845. They should have spent $507. Let's go over to the actual side. They actually used 64,000 feet. They told you they spent $8.55, $547.2. So you can see a couple of things that pop out right now, right? Number one, you've got a price variance of 10 cents unfavorable, and you're going to have a quantity variance, 64 versus 60, 4,000 feet too much. So you should expect to see two unfavorable variances. So in the middle here, we got 64,000 times 845. This is 540,800. Here is my price variance, which is going to be 10 cents over 64,000. This is going to be 6,400 unfavorable. And then you've got a quantity variance that's also unfavorable, 4,000 pounds at 845. This is going to be 33,800 unfavorable, significant variance. Let's take a look at direct labor variances. Again, the standard, they produced 30,000 units. It should take 1.4 hours. They should have used 42,000 hours. The standard price was $16. They should have spent $672. They actually spent 43,500 hours at a price of $15.80 for a total of $687.3. Sorry about that. So you see a couple of things pop up right away. You see a favorable price variance or rate variance, $15.80 versus $16. You also see an unfavorable quantity variance. They should have used 42,000 hours. They used 43.5. 43.5 times $16. This middle number is $696. So you have a rate variance here, which is going to be 10 cents a foot. It's going to be, 20 cents a foot, $8,700 favorable. And you're going to have an efficiency variance here. They use 1,500 hours too much at $16, $24,000 unfavorable. Again, another significant variance. Those are your direct labor variances. Let's take a look at the variable manufacturing overhead. Again, it says here that variable overhead, all overhead is applied on the basis of direct labor hours, but they also told you they spent $108,000 on variable overhead. The standard, well, once again, the actual output was 30,000 units times 1.4 hours per unit. Should have used 42,000 hours. The standard price for variable overhead, also known as the predetermined overhead rates, $250. They should have spent $105,000. Go in the middle here, we know they had 43,500 hours times 250. This middle number is 108,750. You have a rate variance which is favorable of $750, favorable. And you know they're inefficient, right? 1,500 hours too many at 250. You've got a 3,750 unfavorable efficiency variance. The variable overhead simply confirms the fact that they were inefficient. Now let's look at my fixed manufacturing overhead. And what's crucially important here to remember is this middle number is not AQ times SP. This is simply the budget. And they give us the actual number as 211,800. They told the budget was 210. So we have a budget variance of $1,800 unfavorable. What about the volume variance? Well, again, we still have those 30,000 units, 1.4 hours for 42,000 hours. The standard price, which is the predetermined overhead rate, is $6. This far right number, 252. There is a $42,000 what? Favorable variance. This is my volume variance here. $42,000 favorable volume variance. So those are the calculations of the variances. They go on and ask you to summarize the variances. And I did that on my worksheet that they loaded up on Sakai. You can take a look at it. But you simply add up all 8 variances and take the net number. It's a net unfavorable variance of $18,300. But in terms of issues here, you've got the direct materials quantity variance, which was $33,800 unfavorable. Well, there's a problem there. They used too much materials for whatever reason. The corrective action should probably be something like job training, because if they're making mistakes, that's not a good thing. The second significant variance here was the direct labor efficiency variance, which was $24,000 unfavorable. And here they worked too many hours. They were not efficient. So once again, these direct labor employees worked too many hours, probably inexperienced. So between these two variances here, you've got almost $57,000 unfavorable from your direct labor employees making mistakes and working too many hours. In terms of bonuses, I don't necessarily think they deserve a bonus. Who deserves the bonus? Okay. Again, giving the bonus is important. You need to reward the individuals who perform, because if you don't recognize the individuals who perform, they won't perform again. And you cannot be rewarding mediocrity. You cannot be giving bonuses to people who did not perform. So my suggestion is you do not allocate a bonus to the direct labor employees because they're making mistakes and working too many hours. Who deserves a bonus? Well, let's look again. We have a fixed manufacturing overhead volume variance, which is favorable, $42,000 favorable variance. How did that happen? Well, let's have a comparison. How many units did they budget to sell? How many units did they budget to sell? Nowhere in this problem do they tell you how many units they budgeted to sell, but we can figure it out because we know they budgeted 35,000 direct labor hours. That was the denominator value. And we know that it takes 1.4 hours per unit. So we can solve the number of units that they budgeted to sell. They budgeted to sell 25,000 units. Because let's face it, they had to come up with the denominator value. And the first question they had to ask themselves was, how many units do we estimate to sell? They came up with this number, 25,000. We think we're going to sell 25,000 units. It's going to take 1.4 hours per unit. Therefore, our denominator value and our predetermined overhead rate is 35,000. If I know 2, I can find the third. I just solved for the budgeted number of items that they were going to sell. That's the planning budget. They planned on selling 25,000 units. How many units did they actually sell? Actually sold. How many units? Well, they told you that was 30,000 units. All of your SQs were based on that number, 30,000 units. So they sold what? 5,000 units above budget. Who's responsible for sales? Salespeople. So this is your volume variance right here. The volume variance, right? The volume, the number of items you sell, your volume, your activity. So they sold 5,000 units more than budget, 20% more than budget. Who deserves the bonus? The salespeople deserve the bonus. You need to bonus out, you need to reward, you need to recognize the salespeople by giving them the bonus and not the direct labor employees. So that's problem 10 from the appendix. Thank you very much.